Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's founder, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He is not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thank you very much, Carolyn. Every month, we look at the latest economic data to see what they can tell us about real estate markets, where they are now, and where they may be headed. Our underlying premise is that you make better investment decisions when you have a better idea of the economic forces that affect supply and demand. Despite the slowing of inflation and record highs on the stock market, this month we'll review my worries about the actual strength of the economy and the possibility of a recession later this year. That possibility is linked to a possible drop in home prices. And at the end of this month, when new home price data are available, we'll have a better idea of the odds of that actually happening. Here's why. This is a picture of the boom in home prices that affected every market in the country in the last couple of years. It shows the average change in prices each quarter compared to the same quarter of the previous year. It's clear that the boom is largely over, but what we don't know yet is whether it will be followed by a bust. And that matters for the economy because previous busts have shown that falling home prices cause consumers to cut their spending. With the U.S. economy heavily driven by consumer spending, a cut in spending could quickly lead to a recession. Home prices have already fallen in some markets, even high-growth markets like Austin, although they remain strong in other parts of the country, like Florida. The data we get later this month may, or may not, give us a clearer view of what's ahead. In the meantime, let's review the current economy as reflected in the rate at which it's creating jobs. In this chart, we see the percent increase in jobs every month compared to the same month of the previous year. The latest data point is January. The chart shows the recovery from the COVID recession, followed by a long and steady slowing of growth as most of the COVID jobs losses are regained. The current growth rate of about 2% a year seems very strong, but a look behind the scenes shows that it's actually artificially high. In the manufacturing sector, the surge in jobs after the pandemic has completely petered out. The strike in the auto industry didn't help, but even without that interruption, growth was heading towards zero. Since U.S. manufacturing mainly serves the domestic market, it's a sign that domestic demand is slowing. In the construction sector, we see very good sustained growth. Infrastructure and non-residential construction are doing well. But home builders stopped hiring a year ago and have been laying people off. They're still finishing existing projects but aren't expanding, a sign that demand for homes is sharply lower. In the finance sector, new hiring has almost crawled to a halt despite the small surge in January. In the retail sector, the stagnation of the last several years continues. Before the pandemic, growth in the restaurant sector was generally around 1.5% a year. This chart shows that we're almost back down to that level. Business services is one of the biggest sectors of the economy. It provides services that other businesses need. Because it's intertwined with the functioning of all businesses, it's a marker of actual business activity. And the chart shows that after a strong recovery from the COVID recession, growth in this sector has steadily slowed. One reason is the shedding of temporary workers, who could be anything from receptionists to software engineers. Companies contract for temporary workers because they're easily hired and easily fired. And for the past year, they've been firing them at a very high rate, which usually means their own business isn't doing very well. Before the pandemic, growth in the big healthcare sector was close to 2% a year, not the 4% we're currently seeing. It looks like this is an economic engine that could make up for the poor growth in business services. But in reality, the strong growth is mainly due to restocking at nursing homes, which were heavily hit with layoffs in the pandemic. Once those jobs have been refilled, the real growth in healthcare will be much lower. Similarly, job growth in the large government sector that normally is less than 1% a year is currently running at 3%. But much of the reason is strong rehiring by state governments, including jobs at state schools. Like the rehiring at nursing homes, this is a one-shot deal. What all these numbers tell me is that the sustainable growth of jobs in the economy right now is no better than 1% a year, and very likely less. A level where any new shock, like the wars in Ukraine or Israel, or political instability, or a sharp drop in home prices, can shut consumer wallets and produce a recession. That's it. In this time of uncertainty, it's important for bankers and investors to stay on top of local economic and real estate developments. The Local Market Monitor provides the data and analysis they need, with local market reports and investors' metro analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Inga Windsor.